Renee Sega, who's executive head of DebtBusters, joins us to unpack the index and its findings in greater detail.
That the first quarter, we came out of December spending. Black Friday was in November. January was back to school. February might have skipped a couple of debit orders. And now we find ourselves frantically trying to make up on lost time.
I think quarter one is always a difficult time for all the reasons you mentioned, plus the extra expenditures we need to cater for. It's usually the time we are informed by our insurance companies that there's an escalation in what we need to pay annually. It's the time we have to pay the first installment of school fees. It's a lot of things compound in January. It's the time we have to spend actually for school, kids in school, stationery, uniforms, and so on. And December is also a big expenditure month. And in between, we normally go about 6 weeks without any paycheck. So that makes it very difficult. 62% of their take-home pay to service their debt obligations. And part of the reason for that is two things. Like you said, the incomes haven't really grown. So in that environment, it's difficult to make your money stretch as much as you want to. And I think this is something that is important to keep in mind. And the second thing is interest rates have gone up compared to 2020 and 2021, low interest rates. To put into context, many of the debt, about half of the debt or half of the obligations that people come to us with would be what we call unsecured debt. So it would be a combination of credit cards, money owed to stores, personal loans, short-term loans, and so on. On average, we see that the interest rates for those when consumer comes to us is in excess of 25% per annum. That's 25.7% per annum. Just a few short years ago, when interest rates were really low, that was below 21%. Now it's up by 4 percentage points. It's substantial in terms of what we need to service. The age of the consumers applying to debt counselling. A few years ago, about 90% of the applicants would have been 45 or older. Now that's significantly up. That's more 31%. And that's showing to us that consumers are serious about dealing with their debt before going into retirement. A few years ago, we talk about the bonds being really low, 8.3% for your average bond, which is generally around 1.4, 1.5 million rand in South Africa. And right now, the average interest rate for that bond is 12.3%. And the difference between the two is for the consumer to find extra 4,000 rand per month. So we're certainly picking up that elevated interest rates, particularly for bonds and unsecured lending, continue to be probably the highest in the last 4 years. Earning or taking home rather 20,000 rand or more seem to be under continuous strain when it comes to finances. They're paying a big chunk of their salary, or they're needing to use a big chunk of their salary, about 69%, to service their debt agreements. Their debt levels, overall debt level compared to income level, is at quite high. These rates have come down slightly since the last time we spoke, and that actually is a bit of a good news. So what I mean is that a year ago, they would be needing about 65% of their take-home pay. Now that's down to 62%. Doesn't sound like a lot, but it's significant. That the overall debt levels are a little bit muted compared to 2023 levels, which is good. That's a good, welcome improvement as far as we are concerned. So instead of debt to income ratio being around 120%, it's around 107%. Just to educate themselves about what it is that we offer. So I think the first step is always go to the website, debtbusters.co.za. You can sign up for free to use the debt management tools and really see what is your credit profile, what does it tell you, what are the accounts on there, what percent of your salary is going to debt repayments, things like that. And I think consumers can make an educated, decision subsequently once they see those numbers.